Hi there, this is Jake Adams CPA, and right now we're going to be talking about distributing out partnership interests. So if you have an S corporation, if you have an S corporation or C corporation or partnership LLC, we're going to be talking about how to divide those interests up between the partners and how to distribute that money out. So what's going to be coming in is the commissions or the revenue or however way that money is coming in. It's going to be coming in through the top here. And then depending on the structure that you want to use, I'm just going to use a C corporation just for example here. But essentially your commissions or your revenues here are going to come into the partners. And the partners, let's say this is a C corporation, right? Okay, so then the commissions or the revenues coming into the partners, there's going to be some expenses out of here. So those are going to be through the partners or the C corporation, however way you want to set that up. And then whatever is left over, this is going to be the profits. But the thing is, we don't want we probably don't want the profits sitting inside the C corporation because then there's double taxation on it. So what I'm going to recommend is putting this money into a S corporation. And then the S corporation is good because then each of the partners can have their own S corporations. And when each of the partners have their own S corporations, they can do their own tax strategy and figure out kind of the way they want their own taxes, as opposed to having everything lumped together here for all the partners in the single C corporation. This is great because let's say if one partner wants to drive a Maserati and the other one wants to drive a Honda Accord, right? Then you don't have to throw both of them into the C corporation. You can say, okay, well, your profits from this C corporation or partners or profit from the partnership can be distributed to your own S corporation, and then you can have whatever tax write-offs you want out of your own S corporation. So essentially, our goal then, if it's a C corporation or an LLP, an LLC, whatever, is this to be zero, right? And after we distribute it out to all the partners, let's just say this is a 50-50 partnership, right? So you've got this S corporation that owns 50% of this business, and you've got this S corporation that owns 50% of this business as well. So then the goal here is for this business, the C corporation or LLC, LLP, whatever it is to zero out. And when you can zero this out, there's going to be no additional taxes due to the partnership or the S corporation, the C corporation, however way that is. So now once you have your profits essentially distributed to the S corporation, there's no true profits for this entity here. So if we left it like this, then the profits then would be distributed out and shared between the two S corporations. Now what you do inside the S corporation, and I have this diagrammed out on other videos, is the S corporation is going to pay a couple things, right? So one of those is the reasonable compensation. So the reasonable compensation for the shareholders, for the directors, for the employees, who's ever working inside the S corporation, reasonable compensation. You're also going to have the 14-day Augusta rule. So 14-day. You're also going to have reimbursements. This is anything that the employee or the owner-employee owns, but the corporation is getting a benefit for. So this would be things like a personal cell phone or the personal residence for the home office and a personal vehicle. We want to get reimbursed by the S corporation for those expenses. So we've got reasonable compensation, 14-day reimbursement, and then whatever's left over can go to distributions or dividends, whatever you want to call them. So basically whatever's left over. So if you have money sitting inside the S corporation at the end of the year, what you want to do is you want to say, okay, this amount has to be paid out in reasonable compensation. There's a separate video that talks about reasonable compensation, what reasonable compensation is. Some of that should be paid out the 14-day rental strategy, and then some of it should be paid out reimbursements, and then whatever's left over can go to distributions and dividends. Now, one thing that's important with the S corporation to know is that if it's not distributed out to the owner or the employee owner in some way, it's still taxable, right? Whatever flows through into the S corporation is all taxable. So if you have, let's say for instance, you have let's say $200,000 that gets it flows from this business entity of the partnership, and then it goes into here. So let's say this is 200K. And then all of this stuff here is 100K. So then you still have 100K left over, right? And if you have 100K left over, this is taxable to the owner of the S corporation, even though it was never distributed or was never paid out in dividends. It's still taxable because of the S corporation is a flow-through entity. All of the profit earned by the S corporation is taxed to the owners every single year. Right? The only way to get away from that is to go with a C corporation, but then there's double taxation. It may or may not be a good strategy, but we'd have to cover that on a separate video. So essentially that's what is important here. We have revenues, commissions coming in to the partnership, LLP, LLC, partnership, C corporation, however way this is structured. You have the expenses that are coming out of here, and then essentially you want to distribute out evenly or unevenly, depending on how the partnership works, to S corporations, to LLCs, to partnerships, to other places, and then leaving this with zero. And then so this goal, the goal of this formation is to end with zero after the expenses. And then the S corporation would actually be paid, these S corporations are paid as expenses by this business entity, right? So then once that flows through here, and this is zeroed out, once those profits essentially are flowed through into the S corporation, then you can do whatever else you need to do in here, like the reasonable compensation, the 14-day, the reimbursements, the distributions and dividends. Just know that if you have any cash that's left over inside, that was it could be taxable because all your profits that flow through into here are taxable to you at the end of the year because it's a flow through business entity. All right, so hopefully that explains that, and feel free to watch this, feel free to comment, reach out to me if you have any questions. I'm more than happy to walk you through any questions that you have on this. Thanks.